Welcome to Section 8 of the ASC 225 Income Statement Training Series. In this section, we explore other comprehensive income, a powerful concept that reveals economic events GAAP intentionally keeps separate from net income. Understanding why those items are excluded, where they go instead, and how they must be presented is essential knowledge for anyone working with US GAAP financial statements. Let's get started. By the end of this section, you will be able to identify all 5 OCI components under US GAAP and explain why GAAP routes them around net income. You will know which components eventually get recycled back into net income, and when that recycling occurs. You will be able to choose and apply either the single statement or two-statement presentation approach correctly, and you will understand the AOCI roll forward and tax disclosure rules that auditors scrutinize closely. Here is the fundamental question. If something is income or expense, why would GAAP keep it out of net income? The answer is about signal quality. Net income is meant to reflect operating performance, decisions management made during the period. Some economic events, like currency swings on foreign subsidiaries or pension actuarial estimate changes, are real but largely outside management's day-to-day control. If these flowed through net income, they would introduce noise that makes trend analysis harder. So GAAP routes them through OCI instead, still captured in comprehensive income, but clearly separated. The first 2 OCI components involve items that are real but not yet realized. Available for sale debt securities change in fair value every reporting period, but because you have not sold them, the gain or loss sits in OCI until you do. When you sell or recognize a credit loss, that amount is reclassified into net income. Foreign currency translation adjustments work similarly. Translating a foreign subsidiary's financials into the parent's reporting currency creates differences that park in OCI. Those differences only recycle to net income when the subsidiary is sold or liquidated. Cash flow hedges protect against variability in future cash flows, locking in a commodity price or interest rate, for example. The effective portion of the hedge gain or loss stays in OCI until the hedge transaction hits net income. At that point, both the hedged item and the offsetting hedge impact hit net income together. Pension and OPEB plans involve long-term promises, and actuarial assumptions change every year. Those actuarial gains and losses can be enormous and would create wild swings in net income. So they enter OCI and are gradually amortized into net income over employees' remaining service periods. This 5th component addresses a subtle but important problem. When an entity elects the fair value option for its own liabilities, the liability's fair value rises when the entity's credit deteriorates, which would create a gain in net income precisely when things are going badly. That is counterintuitive and misleading to readers. ASC 825 solves this by routing the portion of fair value change attributable to the entity's own credit risk through OCI instead. Only the portion driven by other market factors flows through net income, resulting in a cleaner and more honest net income signal. Recycling is one of the most critical mechanics to understand. When an amount originally recognized in OCI finally affects net income, because the hedged item was recognized, the AFS security was sold, or a pension amount was amortized, that reclassification must be shown separately. Without that disclosure, readers would see the same economic gain appear twice, once in OCI when initially recognized, and again in net income when reclassified. The separation prevents that double count. Timing is not optional. GAAP prescribes exactly when each component is recycled. Improper recycling timing consistently appears as an audit finding. Get this right. Think of a OCI as OCI's running total, the accumulation of every OCI item recognized over the entity's history that has not yet been recycled into net income. It lives on the balance sheet inside stockholders' equity. GAAP requires a roll forward showing the beginning balance, current period OCI activity, reclassifications out, and ending balance, separately for each component. For tax effects, you have a choice. Present each OCI component net of its own related tax effect, or show all OCI components gross and report one combined tax line. Either way, note disclosures must break out the tax impact by component. Knowing what belongs in OCI is only half the picture. You also need to know what does not. Prior period error corrections are restated directly to retained earnings with no income statement effect at all, under a SC 250. Most accounting policy changes under a SC 250 are also handled retrospectively, adjusting retained earnings rather than flowing through any income measure. And capital transactions, issuing stock, paying dividends, repurchasing shares, go straight to equity components and never touch income or OCI. Misrouting any of these items into OCI would be a misstatement. When in doubt, ask, is this a deferred or unrealized economic gain or loss? If not, it likely does not belong in OCI. A SC 220 gives preparers a genuine choice in how they display comprehensive income. The single statement approach is compact. You start with revenues, work down through net income, then continue directly into OCI components, ending at total comprehensive income, all in one document. The two-statement approach splits the presentation. A traditional income statement stops at net income, and a separate statement immediately following picks up from that net income figure and adds OCI components to arrive at comprehensive income. The critical rule for two statements is that they must be consecutive. No other financial statement or schedule may be inserted between them. Walk through this concrete example. An entity reports net income of $275,000. In the same period, 3 OCI events occurred. An unrealized gain of $22,000 on a FS securities net of $8,000 tax, a pension actuarial loss of $15,000 net of $5,000 tax, and a foreign currency translation adjustment of negative $8,000. Adding those three together gives total OCI of negative $1,000. Comprehensive income is net income plus total OCI. $275,000 minus $1,000 equals $274,000. Notice that while net income looks strong, the OCI items nearly offset $1 of every dollar earned. Exactly the kind of context comprehensive income is designed to provide. Let's lock in the key points from this section. OCI is not a catch-all for errors. It captures specific economic events that GAAP intentionally excludes from net income to protect the clarity of operating performance. There are 5 defined components, each with its own recycling rules, and getting the timing wrong is one of the most common audit findings in this area. A OCI requires a component-level roll forward, and tax effects must be disclosed by component regardless of your presentation choice. And remember the hard prohibition. You cannot present OCI only in the statement of changes in equity. It must appear in either a combined statement or a separate statement of OCI. I thank you for completing this section on other comprehensive income and presentation approaches.